Can I Retire? By Mike Piper. The title is a question. That is not an accident. Mike Piper is not the kind of financial writer who titles his books with imperatives or promises. He does not tell you that you can retire earlier than you think, or that the secret to retirement freedom is simpler than you've been told, or that his system will transform your financial future. He asks a question. The question you are actually asking. The question that sits quietly beneath every retirement spreadsheet, every projected portfolio balance, every conversation with a financial advisor. Can I? Am I there? Is what I have enough? Piper is a CPA and the author of multiple plain language personal finance books, and Can I Retire is perhaps the purest expression of his philosophy. That most personal finance advice is unnecessarily complicated, and that the underlying principles, clearly stated, are accessible to any intelligent adult who is willing to engage with them. The book is short, under 150 pages in most editions. It covers the core financial questions of retirement readiness with a precision and clarity that most longer books do not achieve. And it is organized around the actual decision the reader is trying to make. Not how should I think about retirement in general, but am I specifically in a position to retire? Let's walk through the book's framework completely, every concept, every calculation, every decision tool, and then assess it honestly. Part 1. The fundamental question. Do you have enough? Piper opens with what he calls the basic retirement math, the calculation that sits at the foundation of every retirement readiness assessment, however sophisticated. The question is, will your assets last as long as you do? And answering it requires three things: an estimate of your annual spending in retirement, an estimate of how long your retirement will last, and an understanding of what return your portfolio will earn over that period. These three inputs interact in ways that are mathematically straightforward. The complexity in retirement planning comes not from the math itself, but from the uncertainty in each of these inputs, and from the consequences of being wrong. Piper introduces the concept of the safe withdrawal rate as the primary tool for answering the fundamental question. If you can identify an annual withdrawal amount that your portfolio can sustain with a high probability across a range of market scenarios for a 30-year retirement, you know what level of assets is required to support any given level of annual spending. The most commonly cited safe withdrawal rate, 4%, derived from the research we discussed in the Ben summary, means that a portfolio of $1 million can support annual spending of approximately $40,000 with a high probability of lasting 30 years. Equivalently, if you need $60,000 per year from your portfolio, you need a portfolio of approximately $1.5 million. Piper is careful, more careful than most popular treatments of this topic, about the assumptions embedded in the 4% rate. The figure is derived from U.S. historical data. It assumes a specific portfolio composition, roughly 60% equities, 40% bonds. It is calibrated to a 30-year retirement horizon, which may underestimate the needs of someone retiring at 55. And it represents a historical observation, not a guarantee. A 4% withdrawal rate has never failed historically, but there is no law of nature requiring it to succeed in the future. He introduces the concept of failure rates, the percentage of historical 30-year periods in which a given withdrawal strategy would have depleted the portfolio before 30 years elapsed, as the appropriate way to think about retirement security. A strategy with a 5% failure rate is not certain to work. It is the kind of odds, Piper suggests, that should make a thoughtful person at least consider building some additional safety margin into their planning. Part 2. Guaranteed income. The foundation of retirement security. One of the most important structural insights in Piper's framework is the role of guaranteed income sources, primarily Social Security and any pension income, in the retirement readiness calculation. This is not simply an additive adjustment. You need less from your portfolio if you have Social Security. It is a more fundamental point about what guaranteed income does to the nature of the financial risk you are taking. A retiree whose basic living expenses are fully covered by guaranteed income, Social Security plus a pension that together cover housing, food, utilities, and other non-discretionary spending, is in a fundamentally different risk position than a retiree who must fund all expenses from portfolio withdrawals. The first person's portfolio is not a survival necessity. It is a source of discretionary spending, travel, gifts, experiences, unexpected expenses, and it can afford to take meaningful investment risk because a bad market year does not threaten the necessities of life. The second person's portfolio is existentially necessary. Every dollar of it is on the line with each passing year and the psychological and financial consequences of a significant market decline are correspondingly more serious. Piper uses this distinction to reframe the safe withdrawal rate question. The relevant calculation is not what withdrawal rate do I need for my total portfolio, but what withdrawal rate do I need for my portfolio above and beyond what guaranteed income already provides. For someone with $24,000 per year in Social Security who needs $40,000 per year in total spending, the portfolio only needs to provide $16,000 per year, a much more achievable target from a much smaller portfolio than the total $40,000 need would suggest. This reframing has an important practical implication for the Social Security claiming decision, which Piper addresses directly. Delaying Social Security to maximize the monthly benefit is, in effect, a way of reducing the withdrawal demand on your investable portfolio for the rest of your life, and therefore reducing the portfolio size required to sustain your desired lifestyle. The calculation of whether to delay is not just how long do I need to live to break even on the delayed benefits, but how much smaller does my required portfolio become if I have higher guaranteed income? For many retirees, the reduced portfolio requirement from a higher Social Security benefit is worth as much or more than the break-even analysis alone suggests. Part 3. Portfolio construction for retirement. Simple, diversified, low-cost. Piper's investment philosophy is among the most clearly and concisely stated in retirement literature. And it is worth spending real time on it because it cuts through an enormous amount of complexity that is not adding value. The core recommendation: own a diversified portfolio of low-cost index funds, rebalance periodically, and do not try to time the market or select individual securities. This is not Piper being evasive or oversimplifying. It is the conclusion of decades of evidence on investor outcomes, academic research on market efficiency, and practical observation of what distinguishes the minority of investors who do well over long periods from the majority who do not. He makes the case for simplicity in retirement portfolios with specific force. The retired person who owns 5 to 10 individual stocks, several actively managed mutual funds, a handful of bond funds, and perhaps some real estate investment trusts is not diversified more effectively than the person who owns 3 or 4 index funds. They are incurring significantly higher costs, generating more taxable events, and taking more time to manage for no measurable improvement in expected return. The additional complexity is not serving them. It is serving the financial services industry, which earns fees and commissions from every additional layer of complexity. Piper's specific recommendation for a simple retirement portfolio is a version of what the financial planning community calls a 3-fund portfolio: a total U.S. stock market index fund, a total international stock market index fund, and a total U.S. bond market index fund. The proportions between these 3 funds determine the risk and expected return profile of the portfolio. A 60-40 split between equities and bonds is a common starting point for retirement phase portfolios, though Piper, consistent with the research discussed in the Ben summary, argues that many retirees should maintain higher equity allocations than they intuitively prefer. On asset allocation, Piper is explicit about the primary risk factor that most retirement investors get wrong: underestimating inflation risk relative to market risk. The retiree who moves heavily into bonds to avoid the volatility of the stock market has not eliminated risk. They have traded market risk for the slower and less visible but equally serious risk of their purchasing power being eroded over 20 or 30 years of retirement. A bond-heavy portfolio that earns 3% per year nominal while inflation runs at 2.5% is growing at 0.5% in real terms, a pace that will not sustain a multi-decade retirement at most spending levels. Part 4. Sequence of returns risk. The retirement-specific danger. Piper devotes careful attention to sequence of returns risk, the specific retirement phase only risk that the order in which investment returns occur matters enormously for portfolio longevity. During the accumulation phase, When you are adding to a portfolio rather than withdrawing from it, the sequence of returns has essentially no impact on ending wealth. A person who contributes the same amount each month for 30 years will end up with approximately the same portfolio, regardless of whether the good years come early or late in the period. In retirement, when withdrawals are being taken from the portfolio, the sequence is everything. A retiree who experiences a severe market decline in years 1 through 5, while the portfolio is at its largest and while ongoing withdrawals are compounding the drawdown, may permanently impair their portfolio in ways that cannot be recovered even if subsequent returns are excellent. A retiree who experiences the same severe decline in years 20 through 25, by which point the portfolio has been substantially drawn down and the remaining investment horizon is shorter, faces a much less damaging consequence from the same percentage decline. This asymmetry, the outsized damage of early bad returns, is sequence of returns risk. And Piper identifies it as the primary reason that the safe withdrawal rate is lower than the long-term average return of a balanced portfolio would suggest. The 4% rule is not calibrated to the average case. It is calibrated to survive the worst historical sequence of returns the U.S. market has produced. The practical implication for retirement planning is that flexibility in spending during market downturns is enormously valuable. The retiree who can reduce spending by even 10 to 15% during severe market years, dining out less, delaying a planned trip, deferring a major purchase, can meaningfully reduce their probability of portfolio depletion without making a permanent lifestyle sacrifice. Piper discusses several specific guardrail strategies, preset rules for spending adjustments triggered by portfolio performance metrics that operationalize this flexibility without requiring constant stressful monitoring. Part 5. The role of annuities. Solving the longevity problem. Piper's treatment of annuities is more balanced and more favorable than the reflexive dismissal that many personal finance writers offer. And it is worth understanding why. The fundamental problem that annuities solve is longevity risk, the risk of outliving your money. A retiree who is drawing down a portfolio cannot know how long the portfolio needs to last. It might need to last 20 years. It might need to last 40. The uncertainty requires planning for the longest plausible scenario, which in turn requires either accumulating much more than might be necessary or accepting a much lower safe withdrawal rate than might be achievable. An immediate fixed annuity, specifically the simple kind in which you give an insurance company a lump sum and they promise to pay you a fixed monthly amount for the rest of your life, however long that turns out to be, solves this problem by pooling longevity risk across many annuity holders. The insurance company can pay each annuitant generously because the people who die young subsidize the payments to those who live long. The individual retiree cannot replicate this pooling effect on their own. Piper distinguishes sharply between simple immediate fixed annuities, which he treats respectfully as a legitimate retirement income tool, and the complex, commission-heavy variable and indexed annuity products that are frequently sold to retirees by insurance salespeople. Variable annuities with multiple rider fees, surrender charges, and complex benefit calculations are frequently the most expensive and least transparent financial products in the retirement marketplace. The underlying insurance concept is not the problem. The layer of fees and complexity that the financial services industry has added to it is. His framework for thinking about annuity allocation is practical and clear. Annuities make the most sense for covering the gap between guaranteed income, Social Security, pensions, and basic necessary spending. The portion of your retirement spending that exceeds guaranteed income and is genuinely non-discretionary, housing, food, utilities, healthcare, is the portion whose longevity risk is most dangerous and most worth insuring. The discretionary portion, travel, entertainment, gifts, can tolerate the uncertainty of portfolio-dependent income. Part 6. The Retirement Readiness Checklist. Piper closes with a practical checklist, a set of specific questions that a person should be able to answer affirmatively before concluding that they are financially ready to retire. This section is the book's most directly actionable, and it is worth walking through each item. Do you have a clear estimate of your retirement spending? Not a guess. A detailed, category-by-category projection of what you will actually spend in retirement, adjusted for the expenses that will disappear, commuting, work clothing, professional dues, and the expenses that will increase, healthcare, travel in the early years, potentially long-term care later. Do your income sources cover your expenses? Add up Social Security, any pension, any planned part-time income, and the sustainable withdrawal from your portfolio, using a conservative rate of 3 to 4%. Does the sum cover your projected spending with some margin? If not, what is the gap and how do you plan to close it? Do you have a plan for healthcare from retirement to Medicare eligibility and a plan for healthcare costs beyond Medicare? These two distinct questions are both necessary and frequently unaddressed. Have you modeled your Social Security claiming strategy? Not just the break-even calculation, but the full couple strategy if you are married, including the survivor benefit implications. Do you have a plan for long-term care? Whether self-insurance, insurance coverage, or family support, acknowledging that the plan is not simply "we'll figure it out when we need to." Is your portfolio allocation appropriate for your spending needs and your risk tolerance? Specifically, do you have enough in conservative assets to fund 2 to 3 years of spending without needing to sell equities? Have you addressed the estate planning documents, will, power of attorney, healthcare directive, and beneficiary designations on all accounts? And finally, do you have a sense of what you will do with your time? Not a vague answer, but a genuine, specific account of what the structure of your days will look like and where the meaning and engagement will come from. The critique, "Where Can I Retire?" has limits the book's greatest strength, its brevity and clarity, is also its primary limitation. In fewer than 150 pages, Piper covers the essential framework of retirement readiness with admirable precision. But essential frameworks, by definition, leave out nuance. And in retirement planning, the nuance is frequently where the most important decisions live. The treatment of withdrawal strategies, for example, is limited to the basic safe withdrawal rate framework without deep exploration of dynamic strategies, the bucket approach, or the tax optimization of withdrawals across account types. Readers who want to understand the full toolkit of retirement income planning will need to supplement this book considerably. The Social Security section, while accurate in its core guidance, does not address the full complexity of claiming decisions for people in non-standard situations. Divorced individuals with ex-spousal benefit options, widows and widowers with survivor benefit decisions, people with government pension offset issues, and those with both U.S. Social Security and foreign pension entitlements. These situations are common enough that their absence is notable. The investment guidance, while sound in principle, is presented at a level of generality that some readers will find insufficient. Own low-cost index funds and rebalance periodically is correct, but the specific questions of which funds, through which account types, with what rebalancing rules, and with what tax implications are genuinely important and are not fully addressed. And the book's focus on financial readiness, while appropriately rigorous, means that the non-financial dimensions of retirement preparation, the psychological transition, the identity questions, the relational changes, receive relatively little attention. For readers who have the financial questions reasonably well in hand, but who are uncertain about the human questions of retirement, this book will feel incomplete. Final thoughts. Mike Piper's contribution to retirement planning literature is the same contribution he makes across his body of work, the clear statement, in plain language, of what actually matters and what the evidence actually says.
No upsell.
No complexity for its own sake.
No intimidation.
Just the question you are asking, honestly answered with the tools available to answer it. Can I retire? Here is how to know. Here is what you need to calculate. Here is what the evidence says about safe withdrawal rates, about the value of guaranteed income, about the portfolio allocation that balances growth and stability across a long retirement. Here is what you may be overlooking. Here is the checklist. It is not the only retirement book you should read, but it may be the first one, the one that gives you the framework within which everything else you read will find its place. The question matters. The answer is within reach. And knowing how to calculate it, with honesty about what you know and what you don't, is the beginning of everything.